communicate something. Hi, everybody. This is Jeff Fowler with the Apartment Owners Association, and it's great to have you with us today. Beautiful day here in Southern California. And today we're going to be talking about DSTs, and you're going to get a proper education today for sure. We have two great speakers, but before we get into that, AOA, we've been around for over 40 years, and man, it's been such a pleasure to help everybody understand what they can do, what they have to do to raise their rent, or what it takes to get somebody evicted, and helping you avoid all the landmines and all the craziness. It's been our pleasure to do that. And man, we get just insane number of calls every day, it seems like, with people with questions. And so we're so glad that you're part of that group that's staying informed and being super successful with what you're doing. And that's really our goal, is that that our group would be the most successful group of apartment owners in the state, hands down, because of the content that we're delivering either on the live streams or through the magazine. And anyway, just with that, like, I know that there's some of you're looking maybe if you're in your fourth quarter here and you're wanting to exit, this is a great strategy. Other opportunities or other things that you could possibly consider as well is just automating what you have. We do have property management software, and the first 6 months of that subscription are free if you're a member. And so that's just another member benefit that I want to mention. And we do have, next week, we have a double header live stream. We have one about EV chargers, and this is just continuing to become a bigger and bigger thing here in California, and you can't ignore it, unfortunately. So watch that live stream next week. And then also we're going to be covering new resident manager laws for the state of California. Both of these things are statewide. Doesn't matter where you're at. It's information that you'll need. And we will be in person next week in Long Beach. And actually our speakers today will be there. So that'll be cool. You can meet them in person next week. And along with two others, we're going to have Mr. ADU. He'll be there. And then a third speaker will be covering the top 10 tax tips for 2024. So three different seminars, one event in Long Beach on the 23rd. So we hope that you'll be able to make that. And then Sherman Oaks, we're going to cover the same thing, top 10 tax tips, and Mr. ADU will be there. So that'll just be a double header, not a triple. February 7th, if you're in San Diego, Franco Simone will be covering the kind of like the procedures and the different things that you need to have in place for, I believe, for rent increases and evictions. So just those proper notices. San Diego, things just changed there recently, so that may be one that you want to catch. And that will be on February 7th, 3:30 at the Central Library. And anyway, so lots of different things going on. There's even more than that, but I'll stop there just because that's enough for now. Anyway, if you're not a member, if you didn't know, we give a 100% money back guarantee within the first year. And yeah, what else? You have the free forms. There's all the different things that you have access to. You can call in anytime during business hours, of course, and we'll try to help you with your call, or we'll refer you on to somebody more qualified than us, attorneys that could take care of you. And if you're watching on AOAUSA.com today, there's that blue help button at the bottom, and you can just put your question, type your question in there, and they will get that question over to me so that we can discuss those things after the presentation today. All right, so our sponsor today, just want to give a shout out to DSTs 1031 Investments, and they are our sponsor today. They've done over 500 million in DSTs, and what I just kind of gleaned is that they have flexibility in their offerings. They have an extensive network, and they do their due diligence in-house. They're not just contracting that off to somebody else. So those are some of the distinct things that I saw just in reviewing what they have. And anyway, our speakers today, I can't wait for you guys to meet them. Highly qualified. Our first speaker, there's going to be tag teaming, but she's underwritten over 300 apartments in Los Angeles, which is insane. Worked with Marcus and Millichap, and she's licensed DST registered representative with DST's 1031 investments. And then also we have a gentleman who's been a real estate investor for over 30 years, 13 years that he's been licensed with FINRA, securities registered representative. And so it's my pleasure to introduce to you Becky and Sam. So you guys, great to have you with us today.
Thanks. So Becky, you want to start?
Yeah, just to echo him, thank you, Jeff, for the introduction. I'm Becky Eriksson. As he was saying before this, my background is first in commercial real estate. I used to work with a triple net developer out of college who built Home Depot's exporting goods and has graduated in doing apartments and hotels. Afterwards, I got my real estate license and worked at Marcus and Millichap for about 5 years in the South Central market. I've underwritten over 300 properties easily. I've seen the ins and outs of the good, the bad, the ugly. And then I transitioned into this role working with my partner in the DST space for about 2 years. I'm a licensed rep as well with FINRA. And then Sam, I'll allow you to introduce yourself.
Yep. Thanks, Jeff. Yeah, I'm Sam Bhushan. I've been involved with commercial real estate for 30 years. We have a family office of lots of real estate nationwide. So we're owner operators as well. And I've been in the TIC and DST space for 25 years. I worked for one of the first DST companies back in 2009 when DSTs were getting launched. And we're one of the top DST brokers now in the United States. We clear through Cabin Securities, Becky and I, and just want to go through and start educating you all on 1031s and DSTs today. So I will put up our share screen and go.
So what is a 1031 exchange? A 1031 exchange is an IRS recognized tax deferral strategy for an investor to sell their investment property and acquire a like-kind property with the intent to defer their capital gains and depreciation recapture. 100% of the proceeds need to be reinvested in the like-kind. Where we see investors get hung up on is the like-kind part. Really, that's just real property to real property. And there's a whole list here. You don't need to trade from your apartment building into another apartment. You can go into single family homes, condominiums, duplexes, office, retail, self-storage, warehouse, land, mineral and air rights, tenants in common, and then what we're going to be talking about today, which is the Delaware Statutory Trust investments. Also, another thing we've noticed is that investors only believe they have to reinvest the proceeds that they receive from the property. That's not the case. You have to reinvest the value that you sold your property. For example, if you sold for $1 million, you have to give or take replace $1 million. Transaction cost is not part of the exchange, but for a good rule of thumb, if you sold for $1 million, you have to replace $1 million. Now, what if you only had $500,000 in proceeds and there's a $500,000 loan that you had on the property? The IRS still expects you to replace the full value, that $500,000 in proceeds and that $500,000 in debt. Either you're getting another loan or you're putting money out of your own pocket from your bank to fill that hole. If you don't do that, you'll just be taxed on the difference, and that's considered but for a good rule of thumb, you sold what you sold for, you have to replace that. Next page. So in a 1031, it's actually a very strict timeline. This is not a time for you to take a vacation. You actually have to be here. And you have to set up the exchange before you close on your property, on your relinquished property. And that's with a third party qualified intermediary. Now, if you don't have that relationship, we're happy to introduce you. We know we worked with over 200 qualified intermediaries, and we know the good ones. And so you set up the exchange prior to the close. Very, very important. You can't do it there. And then so from the day zero, when you close your relinquished property, which is another word is called the down leg, you have 180 days to close on your replacement property, your up leg. Where the kicker is, and that's 6 months, where people get stuck in the weeds, is the 45-day calendar day ID period. At that time, you have to submit a form on the properties that you want to procure by that 180th day. So in that time, you're looking for inventory, which is super neat about this is that in the DSTs, you can identify it on the last day and close 2 days later, depending on how fast you fill out that paperwork. But for the timeline, you have the day that you close your relinquished property. Your relinquished property, you have 180 days to close on your replacement property, 6 months. And then it's the 45-day calendar ID period you have to be very mindful of when you're looking for your properties. There's a couple rules and we'll get into that later on. Next page.
Okay, so I'll take it from here. So most people do 1031 exchanges for a variety of reasons, as I'm sure most of you are familiar with how it works. When you're owning properties and they go up in value, you have gains, and generally when you sell the property, you have to pay the taxes. Now, here in California, with a lot of our investors, you have to, if you sell a property with a lot of capital gains, you have to pay 20% to the federal government. You might pay anywhere from 10 to 15% state tax, California, on the gain. And then you got to pay 25% depreciation recapture on all the depreciation you've taken. And then there's a 3.8% another tax, Obamacare tax, that you can pay. That can be anywhere up from 30 to 40% of the gains on your property go to the government in California if you sell the property. That's why most investors, when they have a lot of inbuilt gains, they do a 1031 exchange. So you preserve your right to keep doing that. You build your wealth that way. In our family, we've built a substantial amount of wealth by doing 1031 exchanges since 1970. We don't pay the taxes. We just keep rolling the equity from one deal to the next deal. So that's how you accumulate and preserve wealth. You generally, in our client base, we have hundreds of clients in the Southern California area that have sold apartments and different rental properties. Generally, when you do a 1031 and you unlock all the equity that's in your property, and then you put that to work, let's say in a DST, you generally are increasing your cash flow into that new asset because you're unlocking all the equity you have in the property and you're putting it to work at a 4, 5, 6% rate of return in another piece of real estate, so that you generally can increase your cash flow. It depends on what your basis is in the property, when you bought it, and what you're selling for it. But in our clients, we've generally increased cash flow when they go into the next exchange. Increased purchasing power. You have the ability to leverage up or take no leverage in a 1031. So if you sold a property for $1 million and you don't have a loan on it, you can buy a replacement property for $1 million. Or you can theoretically buy $2 million of property in a DST if you get the leverage portion, the loan portion assigned to you, or if you buy it on your own. So you can buy more real estate through leverage in an exchange as well. Switching property types. A lot of our clients own properties all across the United States. They may be only in self-storage properties or only in owning single-family homes, or they may be only owning rental property like triplexes or what have you. And sometimes they want to exit that type of asset class. So that's what the 1031 allows you. You sell that property, you get your proceeds, and now you can invest in any type of property in any location in the United States. Again, DSTs are a really good way to do that, but you can do that with any 1031 exchange, and you can switch your property types. Get into other real estate markets. So We happen to have a lot of clients in California. A lot of them still stay living here, but they may want to take their 1031 proceeds and invest outside of California. That's hard to do from a due diligence point of view because they may not be familiar with the markets in, let's say, North Carolina or Texas or Florida. Whereas in the DST space, what we'll get into, these syndicators buy all across the United States, primarily outside of California. They generally buy at a higher cap rate, so you can get more yield from your investments and you can diversify your real estate outside of California. But there are a few DSTs in California as well. And then in a 1031, also the objective is a lot of our investors use this strategy called swap till you drop. It's kind of a morbid term. You keep doing 1031 exchanges, you never pay the taxes, and then you end up giving the real estate to your heirs when you pass away, and then they get the real estate at a step up in basis at the current market value. So when the real estate actually sells, the heirs don't have to pay any taxes because the property is stepped up to them. This is a very important concept combined with the DSTs we'll talk about more, that most real estate investors use to preserve wealth and build wealth in real estate. And the 1031 allows you to do it. So let's talk a little bit about the DSTs. So DSTs, it stands for Delaware Statutory Trust. And Delaware Statutory Trusts have actually been around for many, many, many years. And back in 2004, they got approved as a structure for syndicators that sponsors big companies to use the DST as a 1031 vehicle. So what they do now is when a sponsor, that's a company that puts these deals together, goes and buys like a 500 unit multifamily apartment deal, they'll buy it with their own money. They'll finance it, they'll buy it, they'll underwrite it, and they'll acquire it. After they acquire it, they put it into this structure called the Delaware Statutory Trust, which is a legal entity. And after that, they will create an investment security around the investment. So there has to be FINRAs involved, the SEC is involved, and they have to create a private placement memorandum with all the risks and all the benefits of the investment and all the leases, all the things go into that document. And then Becky and I are able to vet that deal through our broker dealer. And then we're able to show it to investors like you who are in the middle of a 1031. So you can 1031 into that specific deal. So that's kind of how it works. But in a basic sense, it's just large syndicators buying big, large pieces of real estate, putting it into a syndication, and then you as the investor have the right to 1031 into that investment and get your pro rata share ownership of that investment. And then you don't have to do any of the management. They manage it for you, and we'll get more into how that works. But that's what a Delaware Statutory Trust is, and they are approved in all 50 states for investors to defer their taxes and go into these investment vehicles. Just one little note. Delaware Statutory Trust, it's different from Deferred Sales Trust, which also stands DST. So Delaware Statutory Trust is what we're involved in as the tax deferred vehicle. Okay, so why passive? So a lot of investors, of our investors who own commercial real estate assets, a lot of them are spending a lot of their time and effort managing those assets. It all depends on where you are in your life cycle. A lot of our investors do not want to manage real estate anymore. They're getting tired of what we call trash toilets and tenants. They're looking for some passive option where they can preserve the gains of their property, lock in the profit, but then do a 1031, not pay the taxes, but then they don't want to buy another property necessarily across the street where they have to manage that asset again. They'd rather go into a passive vehicle. That's where the DSTs comes in, where at any given day, like today, for instance, there's about 93 DSTs available from 50 different syndicators in the marketplace. So if you were an investor and you were in the middle of an exchange, Becky and I would be able to show you a variety of DST offerings that can fit from a variety of sponsors with a variety of asset classes, right? And you would be a passive investor. So passive ownership, there are pros and cons of passive ownership. You know, the pros are you don't have to do any work, and you go and it's turnkey. You get your monthly distribution from the asset, and you don't do any work until they sell the asset 5 to 7 years from now. And then you have to make another decision with what to do, another 1031. But you don't have to do any work. You don't have to locate the asset. You don't have to finance it. You don't have to underwrite it. And you don't have to manage it. So you're a completely passive investor in the DST vehicle once you go in there. So that's an option for some people. And you will be in that investment with multiple other DST investors, and the syndicator will manage the investment on behalf of all of you. Okay, so let's go into the benefits, and I'm going to drill down on a lot of these because there's a lot to unpack in the DST. So we talked about passive ownership. So the DST is a good structure for investors who are looking to exit the daily property management of their asset. If we have investors who like flipping properties, for instance, and managing them, then the DST might not be a great vehicle for that. But it is good for your older investor who wants to lock in gains and go passive. Income. So in the DSTs, I think about almost 99% of the DST companies, they pay their distributions out monthly, which is very important. So hypothetical example, let's say the DST company bought a property for $100 million and you have $1 million coming out of your exchange. Let's say there's no debt on the property and you do a 1031 into that $100 million apartment complex. You now own 1%, 1 million divided by 100 million of that DST. And let's just say that DST has a 5-year hold period or a 10-year hold period, and it's currently paying 5% cash flow. So the way that works is you put $1 million into that deal, and you are now going to get $50,000 of income a year in that DST. That's based on what that current property is providing after they pay the debt service, if there's a loan on there, after management fees, after all the fees. So you put $1 million in times 5%, you're making 50,000 a year, divided by 12, 4,166 bucks a month is what you would get in that example every month in the DST. Now, every DST you will see has a different projection schedule of what the cash flow will be over the hold period. In certain triple net properties where the lease is a 10-year lease and you know exactly what they're paying, a lot of the DST cash flow is flat. So it might be 5% every year. In an apartment deal or other assets where the income may fluctuate, the syndicator will give you a projection of what they think the DST will pay in income every year throughout the hold period. So that number can change. A lot of times it goes up as rents go up in apartments. You're able to pass that down to the DST investor and get more cash flow. But right now, DSTs are paying between 4 and 6% cash on cash returns based on the equity that you put into the DST. And that's based on lots of different metrics, which we can get into. So that's how the income works. The income can be tax efficient as well. So the majority of our investors who are in the DSTs, they do not pay taxes on all the income from the DST because they get depreciation deduction against their income. Just like the real estate you probably currently own, you are taking depreciation. When you go into the DST, you will get a depreciation schedule for that real estate. Could be multifamily. It could be triple net properties. It could be self-storage. And the taxes will go on your Schedule E of your tax return, just like any other real estate that you've owned. And then your accountant will calculate what the depreciation is against your income. So that is very beneficial for income, the tax sheltering. And if you diversify, we'll go into number 3. That's one of the biggest advantages of DSTs. So if you have somebody selling a property for $2 million in LA, they've had all their eggs in that triplex in LA. Now they can take that $2 million, and DSTs have as low as $100,000 minimum investment. So what Becky and I will do, we'll talk to the investor, learn what their cash flow needs are, what property types they like, what locations they like. We will pick the best sponsors in the industry that have the best track records, and we'll sit down and build a portfolio. So now you could take $2 million of equity and you could put $500,000 into an apartment complex in Texas. You could put $500,000 into a senior living facility in Florida. You could put $500,000 into a triple net DST that has 30 different Walgreens and Dollar Generals and CVS pharmacies. And then you could put $500,000 into maybe 2,000 self-storage units spread out in 19 states. So you cannot do that in a regular 1031 exchange. In a regular 1031 exchange, you bought for $2 million, you buy something from your broker, probably in the same area for the $2 million again, with the same, if you're buying in the same market and selling in the same market, you haven't really accomplished a lot except spending a lot of transactional costs for both transactions. But if you do a 1031 and you do a DST, you can exit the market you were in, go into a completely different market, completely different asset class, and you can diversify through lots of different asset classes. What's available right now in the DST market? Senior living facilities, student housing facilities, multifamily apartments, which is generally Class A and Class B multifamily, is what the syndicators like to buy. They don't buy a lot of value-added assets where there's turnaround. They buy stabilized assets in good markets where there's rent growth and population moving. They're buying in states like Florida, Texas, North Carolina, Tennessee, where population growth is going and job growth is going. That's where the syndicators are buying a lot of these properties. So you can go into industrial properties. Industrial is a big asset class that a lot of investors are investing in. You can go into triple net asset properties, your Walgreens, your Walmarts, CVS pharmacies, these type of assets. And in the DST market, you generally don't buy into one triple net. Like in a regular real estate, you sold a property and you might want to buy an Arby's in Ohio. Well, in the DSTs, what they'll do is they'll buy 20 different assets in 10 different states with really good credit tenants, and they'll put them all into one DST. So now when you put your $1 million into that DST, you don't just own the one Arby's in Ohio. You own a pro rata share of 20 different triple net properties, all with different credit leases and all in different areas. You simply can't do that when you have $100,000 coming out of an exchange, but you can do it with the DSTs. So diversification is really, really important in the DSTs. And we do numerous exchanges where the client will sell something for $2 million. They will find a property that they like to buy for $1.5 million, and there'll be $500,000 left over. And their accountant might not know, and they just think, okay, I got to pay the tax on the $500,000 left over. No, we can get introduced to them. We worked on hundreds of cases like this, and then we could take that $500,000 and put it into 5 different DSTs or 2 different DSTs and take care of the 1031 and pay no taxes on the exchange. So diversification is big. Financing, this has really been important, institutional financing in the last few years, because it used to be interest rates were 2.5%, 3%, 4%, 3.5%, 3% on commercial real estate. And now the interest rates have gone up and they're probably going to creep down. But these syndicators, when they buy properties, they get institutional financing when they buy a $100 million property. They generally get better rates than what an individual investor will get when they're pricing out debt to buy a property. So they can get property financing even today at 5% or even lower in some cases on certain commercial assets, because the CMBS lender or the bank lenders, or all the major lenders lend to the DST structure. They can, because they're buying real estate in bulk or larger pieces of real estate, they can get better financing on the property, which helps the investor. There are also DSTs with no debt on them. So depending on, like, out of the 93 DSTs that are available right now, there's maybe 10 of them that have no financing on them whatsoever. So if you don't need to replace any debt on your 1031, you can go into a DST that has no leverage on it. But if you do have debt on your property that you're selling, then you need to replace that debt in your 1031, and then you might need to go into a DST that has debt on it. We can talk more about that. We got into it, low minimums, DSTs. Becky and I have worked on DSTs as low as 100,000 and lower. Some investors, the sponsors will take lower than 100,000 in a 1031 in a DST, all the way up to $45 million of DST allocations for one client. So, and everything in between. So they basically cover everybody. New depreciation schedule. This is important. We have lots of investors who've owned properties for 20, 30 years, and they've fully depreciated the property. So they're not getting any depreciation benefits. And when they do a 1031 exchange and they lever up, let's say they sold the property for $3 million and they had no debt on it, and we took the 1031 and we put them into a DST that has 50% leverage. So their $3 million of equity actually buys $6 million of real estate in the DST. The cool thing about that is they don't have to be underwritten on the loan. And they don't have to turn in any loan documents to do the loan. The loan, they will get the share of the loan in the property automatically when they buy into the DST. That's a big help to the DST investors, because they don't have to come up with all the documentation to go get financing if they need to replace debt for their 1031. But anyway, they buy more property. Now they have a different basis to depreciate over, which then shelters more of their income on the next 1031 exchange for the DST investments. That's a big deal. And we can get into, if you guys call us offline, we can look at your particular situation and we can calculate how much depreciation benefit you could get. We're not tax accountants. We can't give tax advice, but we can give you in general information about how depreciation works and how you can improve your depreciation schedule by using a DST. So, and you guys might know depreciation is different on different assets. Most of these DST sponsors provide what they call a cost segregation analysis at the end of the year to the investor, so they can accelerate their depreciation on their tax return. That helps a lot. And certain assets you depreciate over 39 years, certain assets 27 and a half years, like apartments. Certain assets you could depreciate over 15 years. And we can get it more into that, as an individual basis. This is a big one. Access to institutional quality real estate. DST syndicators are generally risk averse. They're not buying risky assets because they have thousands of investors selling their relinquished properties, going into these DSTs, and a lot of the investors want to retire on this income they're getting from the DST. So they're not buying turnaround assets or value add assets. They're buying stabilized, professionally managed assets with generally very good credit on the leases, Amazon facilities. If they're going to buy an apartment complex, it's not a rundown C or D of complex. It's an A or a B in a good area that's relatively new construction, that's probably 95 to 100% leased in a good area. So that's the kind of stuff they buy. They're trying to preserve the wealth of the client, at the same time pay good cash flow, and then with upside potential at the end when they sell the property. So institutional quality real estate is what the syndicators like to buy. So that's what you'll be going into in the DSTs. And then we talked about step up in basis upon the death. If you're in a trust or an LLC or husband and wife, and you're in the DST and somebody passes away, the other heir gets the DST at the new current value. So then when the DST sells, that client may not have to do another 1031 exchange. They can take all the proceeds and they can just pocket the money and not have to pay the taxes because they get a step up in basis. So that's another benefit in the DSTs. Active versus passive. This is something that just is comparing what you have to do if you buy your own property versus going to a fractional. You guys all know this. Becky mentioned the 45-day period. Trust me, it goes by very fast if you're in the middle of an exchange. We've worked with many, many clients who thought they were going to buy a property during that 45 days on their own. It ended up they couldn't. We got introduced to them, and they ended up doing a DST even as a backup strategy, putting a DST down on the form to go because they couldn't close on the property. And there's numerous reasons why you can't locate a property in 45 days or arrange financing or get retraded, et cetera, et cetera. The cool thing about the DSTs, they're already bought. They're already sitting on the shelf. You already know what your cash flow is going to be. You already know what the debt service is going to be. You already know everything, and you can close into the DST in as short as 2 days and start your cash flow because it's already sitting on the shelf. All the due diligence has been done. The property is already owned by the sponsor. And all we have to find out is if you're suitable for that deal, if they have equity available in the deal. And then if they do, we do some paperwork, and then the accommodator wires the money into the DST, and your cash flow starts that day. So that's the difference between a prepackaged deal and then, looking for a suitable replacement property during those 45 days. But as we mentioned, it doesn't have to be either or. You can do both DSTs and buy your own property in the middle of an exchange if you want to. Hold on one second. Okay, good. And let me see here. Okay, yeah. So, we discussed this. You have to secure funding on your own when you buy your own replacement property. If you need financing in the DST, it's quick and easy. The funding or the debt is already on the property. You're just going to get the same prorated share of debt that the syndicator already has. Most DSTs have leverage about 40% right now. There are some DSTs that have zero leverage. There are DSTs that go up to 86% leverage if you have a very high debt requirement on your 1031. We can get into all those details on an individual basis. And then you guys know if you buy your own property, you have to deal with the management of the day-to-day. But in a DST, the syndicator takes care of all that, and you don't have to do any management whatsoever. So you're a passive investor. Let's get into some of the risks. So when you buy into a DST, you have all the same underlying risks of the real estate that are there when you buy your own property, right? So if you bought into a DST and it was a 500-unit multifamily property, whatever risks are inherent with owning a 500-unit multifamily property are still there. It's just that the syndicator is going to manage those the property on your behalf and do all that. Another big one is illiquidity. And most, Becky and I tell our investors, unless you're prepared to be in the investment for 5, 7, 10 years, whatever the hold period may be in the DST, we don't recommend you go into a DST if you think you need the money back in 2 years, for instance, because these are not liquid assets. You are in the investment until the DST sells, and then you'll get your money back, and then you can do another exchange. There are situations where there's ability to get out of these DSTs prior to the DST selling, but we'll have to talk offline of how that works and what the procedure for that is in an emergency. And it's not guaranteed what price you will get out at or if you will get out at all. So we can discuss that. But we have seen it being done where investors get out early before the DST actually liquidates. And you will know what the hold period is of that DST prior to you going in. Most DSTs have a 10-year max hold period. Some DSTs have a 5-year max hold period, but you'll know that before you invest in it. And then you have lack of control. So that's another big one. So a lot of investors have to get used to the fact that they're not managing the property anymore. Once you go into the DST, there's a big syndication that's managing it for you, and you now are passive investors. And then, there are, in a DST, you cannot refinance the property. That's another big issue. So whatever debt is on the property, that's what it's there for. Generally, these are locked loans. They're not floating rate debt. So you're not subject to the debt floating rate. So you'll know what the debt service is on the property going in. And then we can talk about other risks, as an individual basis. But I think that's good. And we have a glossary of terms. We can share this for you guys
And these are only offered to accredited investors. You have to
Credit
have,
investors, go ahead.
yeah,
You
you
can
have to have a net worth over $1 million minus your primary residence, or 200,000 income if you're single, 300,000 if you're married. You don't need to be both. You need to be one or the other. But these are only offered to accredited investors.
Great. I guess we can now we can
Questions and
go into
answers.
questions.
Great. Yeah. And if you could unshare the screen and then they can see all of us. There we go. Thank you so much for sharing that. You know, a lot of people, as they're preparing to sell, there's mistakes that people. I was talking to a different broker yesterday, and there's just different mistakes that owners make um, before they even get into selling their building. And with the amount of experience that you guys have, I'm just curious if you could maybe give one or two tips of like things that big mistakes you don't want to make as an owner before you even get to the place of selling. I know it's a little bit different of a question. We don't have any questions right now. So now's the time for you guys to, if you're watching, go ahead, type your question in and we'll get to it. And just before we get there, I'll just ask this one because I think it could be helpful for everybody.
I think a lot of owners get stuck of making their property really presentable before they sell it. Maybe get it occupied if they have vacancies. Rather just, I think, get over that hump, because you don't actually have to do that. Buyers would like to do that themselves and occupy the tenants and pick the tenants themselves and pick the cash flows that they want. So where you're like, I need to get this all situated because I think I'm gonna get more value, especially from the apartment buildings. I say get your market valuation from your broker now. Ask him or her those questions. What do you think if I stabilized it? Would that get me more value? And go over those questions together, because it may not be worth your time and you may add 6 months to a year to your timeline and sell in a worse market. Right now is actually a pretty good time to look at your real estate. Interest rates are expected to drop this year, hopefully a whole basis points. That's what the Fed says for 4 times. And when that happens, there's been pent up demand. You want to take advantage of that, especially if you're trying to net the most right now and go into an exchange with more proceeds so you can get a better return later on.
Great. That's a great point. That's a really great point. People, they actually would prefer it vacant sometimes.
Oh,
In
completely.
most
Even if
cases.
it's value add, like they
Yeah.
want to add it. When I was a broker at Marcus, I had more of a difficult time selling a stabilized property than a value add one. I would get 1 or 2 offers, where in a value add, I would get 13. And then it was great for the seller because we would do a multiple counter and push them up and get more value for them. So if you feel like you need to take on the responsibility and make it better for a person, you're taking away what they actually think is value and when they want to do themselves. And you may end up hurting your net, what you end up getting as proceeds, plus your time, right? You did all of that and then you may miss out. You're selling again at the bottom of the market instead of the top. And this is a good time this year.
Hey, Sam, could you tell us about, you said the due diligence is done in-house. Can you just kind of cover that, just
Sure.
touch on that, please?
So the DSTs, there's a lot of due diligence done on DSTs in general before they get to the end client, or the investor, the 1031 exchanger. By the way, you can put direct cash into these DSTs too. You don't have to be in the middle of a 1031 exchange. We have a lot of investors that just write a check for $500,000 and buy a DST slot. So that when the DST sells, they can do another 1031. It's very cool. And they can defer, get sheltering and income, but that's just a separate thing. So, yeah. So what was your question again? Sorry.
Oh, just just touch on the due diligence.
Yeah. So the
that
due
you're doing
diligence,
in-house. What does
there's
that
like
look
5 or 6 phases of due diligence. So I used to work at 2 or 3 different DST companies prior. And DST companies will have a certain methodology of what they're looking for their sweet spot of the assets they like to buy, right? Whether it's senior living, multifamily, Class B apartments, whatever they really like to buy. Some syndicators buy lots of different asset classes. Some specialize in very narrow things, industrial. So they have acquisition analysts that have worked at companies like CBRE, Marcus, and all that. And those acquisition analysts will comb the entire United States and look at hundreds and hundreds of deals to buy. And they're always talking to brokers. They're looking for direct owners, and they're combing the entire commercial real estate market to buy the assets that they know work for the DST. So they already have a certain methodology. So they're doing all that due diligence. They might, find 30 assets they want to make bids on that fit their criteria after looking at hundreds of them. They'll put off offers on all those. They'll get a bank lender to look at all those 30 properties they want to buy, and then that lender has to do a lot of due diligence on every one of those properties, soils reports, appraisals, you name it, everything, because they're lending the money on it. And then the syndicator is buying billions of dollars of real estate. They're looking at all these assets. At the end of that process, they might buy one asset after looking at hundreds of assets. So once they buy that one asset, what are they doing? They're putting their own money into that deal before any DST money goes in. So they have their own money up into that deal and they purchase it. So right when they already purchased the first asset in the DST, it's not like that deal just fell out of the sky randomly. They already looked at many, many deals. The lenders looked at the deals. They looked at it and they decided, yes, this is what we want to buy. This fits it. So once they acquire the asset and put it into the DST, now comes all the SEC FINRA regulations. They are now creating a security around this investment. That's different than me doing a 1031 exchange and just buying my own property across the street. There are all these regulatory things that have to go into protecting the investor, disclosures of every risk imaginable in the deal. Everything you can imagine that you do on trying to buy your own property is in the prospectus. Plus, there are Dropbox files. Once that happens, and they create the memorandum, then there's these companies that do these things called third-party reports on the DST sponsor and on the individual deal they bought. And these are third-party companies. They come in and they do an analysis of the sponsor who's putting the deal out, every deal they've ever done, every deal they've sold, every deal they're currently managing, and they analyze and then they give a report out on how good is this DST sponsor, et cetera, et cetera. We review those reports. Our broker-dealer reviews. Then they do a report on the individual asset that the DST sponsor bought. And they look at all the projections that the DST sponsor has, all the risks of the deal, all the projections, and then they write an evaluation of what they think of that deal. Our broker-dealer, Cabin Securities, reviews those reports. And then we look at all the DSTs out there, the strength of the sponsor, those reports. And then our broker-dealer might throw out some deals that we don't feel comfortable with, or we think are too high risk, or we don't think meet the criteria that our investors want. And then once we approve those deals that we like, then they get to Becky and I. And then let's just say out of 93 DSTs that are out there, there's 30 deals we really like in various asset classes. Then we'll get to the investor and see what they're looking for, and we'll go through that process and then Becky and I will vet the deal ourselves. And we will look at all the pros and cons of that deal. And then we'll talk to the investor and then we'll match the deal. Does that make any sense? So
Absolutely.
Lots of layers of due diligence.
And our broker dealer will also go to either do a site visit or they go to the sponsor's office, which many of their offices are in Mission Viejo and some are in Pasadena, and talk about the underwriting assumption when they procured the property too. So we're talking with the sponsor directly.
Yes.
Great. All right, we got a few questions here on YouTube. Montevex, how do you cover your outstanding debt? Example, $350,000 mortgage when you're switching to a DST.
Sure, I'll answer that. So let's just say in that example, they sold the property for $1 million, right? There's transaction costs of 6%. So they have 900 and, they have what, 940? And then they have a loan payoff of 350. So here's how it works. They sell the property for $1 million. There's transactional costs. We're using rough numbers. $940. And then they pay off the loan when the escrow closes of $350,000. So the client's left with $590,000 to do their of equity. They have to take that equity and put it into a 1031. They have to put it with a syndicator they have to put it with a 1031 accommodator right when the escrow closes. And they have to get that set up, like Becky said, prior to the escrow.
Mhm.
So now the two requirements for them to do a fully tax deferred exchange is they have to invest the $590,000 into a real property or a DST, and they need to replace the $350,000 loan that was on the property. Now, let's say there's a DST that we find that has 50% leverage on it. That means when the syndicator bought it, they put 50 million up and they got a bank loan for 50 million. That's 50-50 leverage. So if they decided to go into that deal, they would put their $590,000 of equity in the deal. And on their closing statement, when they buy into that DST, the syndicator would assign them another $590,000 of leverage, a note. So the reason it's 50-50 is that's what the syndicator already had on the deal, 50% leverage. So the cool thing is like I said before, the investor doesn't have to provide any documentation to qualify for the loan. They just get their pro rata share of the loan automatically. Now that 590 of debt, that qualifies for the 350 of debt that they needed to cover in their exchange. You don't have to get exact. You just have to get the debt or greater for you to complete the exchange with no taxes due. So that's how you take care of the debt requirement. You go into a DST that has enough leverage on it to cover the debt requirement that the syndicate, that the sales price requires. That's how it works.
Great. All right. And then Liz on YouTube, do the DSTs keep any interest in the asset themselves or just sell out 100%? This is a good question.
That's a very good question. So I would say after doing hundreds of these and looking at over 500 DST deals, the majority of DSTs you see, the syndicator buys the property, all of them own, and then sells out all the interest to the investors. And they end up retaining no interest whatsoever of the property. And they become property managers on behalf of the DST investors. And they make their fees through property management fees. And they make their fees through acquisition fees up front. One key point, they're not allowed to take a profit participation at the end when the property sells. They're allowed to take a disposition fee, like a brokerage fee, to sell it. But if the property doubles in value, they can't take 20% of the profit like there are in other structures. That's a very important point in DSTs. So
the profit goes to the shareholder.
The profit goes to the shareholders. And we've had many investors that have gone full cycle in DSTs and made a lot of profit. But go ahead.
But to the most part, 90% of the sponsors in the space, who, by the way, are fiduciaries to maximize profits for investors, don't keep a vested interest in the property. There are some that do, and they'll let you know when they're advertising it, and that's fully disclosed.
Yeah, like for instance, there's a DST out right now we're looking at where the sponsor retained 20% ownership of the property, but that's rare.
Okay. And Patty on YouTube, if the property you sold has no debt service, are you required to 1031 into DSTs with no debt service, or can you DST into an investment that does have debt service?
You can absolutely do that. If you have no debt, you're pretty much able to do whatever you want. You can go in ones with debt and no debt. People who are 1031 exchanging with debt, they have to go into offerings that have debt to replace their value, right? But since you're debt free, you have free reins to go and look at every opportunity and not worry about replacing debt. The benefit is if you do go into ones with debt, you're owning more real estate value and you get to depreciate that and shelter more of your income.
Yeah, there's pros and cons, which we will discuss with each individual investor if they should take on debt or not in their exchange. But there's absolutely DSTs with no debt on them.
Right. We have Ken here asking, are there any DSTs any of these that have gone belly up?
Yeah, great question. So we've been involved in DSTs. I've been involved DSTs got approval in 2004. They really started getting going in 2009, and then they've raised a lot of money. 2022 was the biggest year on DSTs, raised about 9 billion of equity. And then in 2023, they went down to about 5 billion. I would say 99% of DSTs that we've been seeing have had capital appreciation on the exit of the DST. The reason is not because all these syndicators are geniuses. It's because the market in general has gone up.
Mm-hmm.
Post 2009 to 2023, most asset classes have gone up in value. So if you were in a DST anytime before that, in that realm, and you held for 5 years, it's from most of the ones we've looked at that you've had substantial profit. Now, we tell investors going forward, you're getting in 2023, we do not expect the same appreciation that properties have had prior in other cycles. But I've never been affiliated with a DST that went belly up. But there have been cases where there's been some problems on certain properties, like during COVID, where there's
Right.
so you have,
maybe
like I
not.
said,
So maybe not. Am I hearing you right? You're saying that you haven't seen any go belly up, but you've seen maybe just a couple that didn't have appreciation when they may have for a loss.
I know of a few that the return of capital because of unforeseen circumstances were lower than what the projection was or what they thought they were going to get. I've seen some very out of hundreds and hundreds of deals, strange deals where the investors did lose their equity, but that is extremely rare compared to any other real estate.
I've never seen that with an apartment owner selling their building. I've never seen an apartment owner go belly up.
Never, right?
Just kidding. Yeah,
exactly.
So the risks that are there owning on your own are there with it, but these guys with as much due diligence as they do and the scale that they're doing it on and all this, their chances of getting it right are better than the average bear, but risk is risk.
Risk is risk. Yeah, you will see when you see the DST prospectuses, all the risk that exists will be highlighted there in the deal.
Okay, a couple more here. John, what is a typical expected monthly income for an investor assuming a 1 million DST example that you gave? So what's a cash flow?
It just depends on the asset you pick. Every asset type is different. Just like you're scouring the market now and different listings have different cash flows, that's the same thing here. Generally, it's 4 to 6% on your cash on cash. That's based off the equity you're investing. There are plenty of ones. If you're like Becky, Sam, I'm looking for over 5%. Sam and I can tailor the inventory that we're showing you that have income over 5%. So we can hit your mark, but each offering is different. Each offering is collecting rent differently. Maybe one's multifamily with 300 units. They're collecting rent from that. The other ones are from leases like Walmart's, Walgreens, and they're collecting that, and they have different rent escalations.
Yeah, the average right now out of the 93 DSTs is 4.7% first year cash flow, but there are many that are paying 6 and there are many that are paying 3.5, right? So I'm giving you an average. So in that scenario, you put $1 million in, and let's say they hit the average 4.7, they'd get $47,000 of income a year from that DST.
And people need to compare that to what they're making, what their cash flow is today on their current property.
Correct. After all their time. So there's the thing to leave off. They spend 500 hours during the year and they value their time at 0. And then they try to compare it. You have to value your time, the hassle, and then you have to value your property taxes. I'll have investors saying, oh, I'm making 9% on my property. And then we look at the numbers. They didn't even take into account their expenses. And by the way, they're not making 9% on the true equity of their property. They're making 9% on some basis that they put in. We have to calculate what they're going to make on the equity after they sell the property. That's where you compare the apples and apples. Yeah. Becky and I have spreadsheets where we do this over and over every day, where we compare how much you're making prior to what you would get.
Okay, and here's the last question. How do DSTs make money? So like, how if they're not, so
So there's three primary ways the syndicators make money. When they buy that property for $100 million, you are going to be paying a marked up price to get into that DST. They take an acquisition cost. There might be a loan placement fee. All these fees will be disclosed in the memorandum. And then there might be in a DST, you can never be capital called. So the sponsor will take a reserve account in the DST prior to the deal, so they can't come back to the investors for unforeseen problems too. So that is not a load on the deal. That's still the investor's money that goes back to them if it's never paid, but is in the deal. So they make some money up front. Then they make money as property managers. So in multifamily, they generally take between 3 and 5% of gross rents. So if they have a 500 unit apartment building and they're collecting all the rents and they have the expenses, they'll also take 3 to 5% of the rents as a property management. That's another way they make money. And then these numbers I'm quoting you, 5 to 6% or 4 to 6% cash flow, that's after all these fees. That's net to the investor.
Yeah.
So that's the primarily way they make money. And then when the property exits, some of the DST sponsors make 2 to 3% on the sale price of the property. They act as the brokerage firm to sell the property, and they get a disposition fee when they sell. Some of those disposition fees are subordinate to the investor getting their return of capital back, meaning they can't take that fee until the investor gets all their cash flow that they said they were going to get, plus full return of capital. But yeah, those are the three main ways they make fees.
Well, Becky, Sam, thank you guys so much. And man,
Thank you.
Guys, you can see them in person next week. So go down, if you're in Long Beach, if you're in the area, definitely go on to aoausa.com, go to the seminars page and register now. And anyway, yeah, there's going to be 3 different speakers there anyway, so you can hear them and a couple others as well. So thank you guys again for sharing with us. And yeah, for all of you, I just really, this year, I'm looking for prosperity, and every way that I can help you get there, that's what I'm working on. And I know that these guys are working on that for lots of their clients, and they'd love for you to be their client too. So you see their number at the bottom of the screen there. You can give them a call. And anyway, thanks again, everyone. And don't forget, next week, we have those 2 different live streams, the EV charging and also the resident manager, new laws and regulations for that. So look forward to seeing you next week. Take care.
Thanks, guys.